gold goes up, let's say gold goes up to the old normal eightfold high, which is what, 8,000 plus in price. It would be where it was in 2011, where it was in 1980 in terms of dimension of move. Okay. Do 3.5% of 8,000. Okay. Well, in the couple hundreds. Okay. Yeah. So the point is that major lids are coming off here, not merely price chart stuff. Each of those first moves, the 76 bear low, which was a correction from $200 down near 100, summer of 76, you went from that low near 100 to 850 in that first move. Eightfold move, 8 times the bear market low. Okay. Then you made a low in 2001 in price, and you multiply that times about 8, and what you got? The 2011 high, another eightfold move.
Market strategist Michael Oliver explains why gold may be entering a powerful long-term breakout phase. Gold has a long history of delivering explosive moves after major market bottoms, and according to Michael Oliver, the current setup looks strikingly familiar. In past cycles, gold has repeatedly achieved eightfold gains from major bear market lows. After bottoming near $100 in 1976, gold surged to $850. Similarly, the 2001 low preceded an eightfold rise into the 2011 peak. Oliver notes that if gold were to repeat this historical pattern, prices could climb toward the 8,000 level, representing a structural move rather than short-term chart noise. Even modest percentage gains at those levels would translate into hundreds of dollars per ounce, signaling that traditional price ceilings may no longer apply. The key takeaway is that gold's moves are not random. They reflect long-term shifts in monetary confidence and market psychology. As previous lids came off in 1980 and 2011, Oliver suggests the next phase could be even more significant, positioning gold for a historic advance. Now, we present the clips from Michael's interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates.
Each of those first moves, the 76 bear low, which was a correction from $200 down near 100, summer of 76, you went from that low near 100 to 850 in that first move. Eightfold move, 8 times the bear market low. Okay. Then you made a low in 2001 in price, and you multiply that times about 8, and what you got? The 2011 high, another eightfold move. No, on an arithmetic scale, it would be far more dramatic, but on a ratio, logarithmic scale, which how much did gold go up in multiple? 2 moves of eightfold dimension. If you measure from the bear low in 2015, which was $1,050, it says, well up in the 8,000s. And then finally, you'll have only matched what you did twice before. Hardly a headline. I've done it before twice. It's probably going to go way beyond there. But people who think that gold is overdone right now, we're only 4-fold. So it doesn't compare to the dimensionality of the price changes 76 to 80, 2001, 2011. We're only halfway there. So that's something to pause and think about. Yeah, on an arithmetic scale, you look at the action the last 6 months or so, you say, I got to take profits. Yeah, right. Okay, fine. Do it if you want to. But meanwhile, gold just broke out above the biggest stock market in the world and says, I've just now begun to beat you. Just begun. Well, okay. Anyway, then the real issue for us right now is not gold. Everything there is positive. It's been positive for us since 2016, but it's silver. And this is the same 50-year period of time. Ratio scale again. And you can see that the low end of that rectangle is like $4 or $5. It's about $4 back in 1993 and also in the mid 70s. And you shot up there in 1980 to $50. Okay, so it's a little bit better move than that first gold move. Gold went up eightfold, silver went up about tenfold during that multi-year move, with a lot of it compressed in the last 6 months of that move, where you really exploded. Okay, then you went sideways for decades, and then in 2011. Again, with a spurt in the last 6-7 months of that move, that's the second ellipse there. Then you went up to 50 again. Okay. And meanwhile, gold's blasted way above that first high, right? Okay. Yep. Eightfold. Silver's the same fold over and over. Okay. Then you come back down again in silver, mid-range this time, based. And now you've punched through. That last reading is $62. We're now trading at about $65. This is as of a week ago. But you finally punched out of that range a bit. Now, that's a price chart. We look primarily at momentum, and momentum has already said you're going to leave the earth here. Okay. Price now sort of says, oh, me too. Okay. But if you take the dimensionality of those first 2 swings, which were redundant in the case of silver, and swing it up and say, okay, I'm going to match the logarithmic scale dimension of that rectangle. It says $500. This is log scale, remember. So 500 would be about where that arrow top is, that third arrow, the second arrow. That'd be about $500. That's crazy, right? Yeah, okay, well, maybe it is. Silver, how come silver didn't do what gold did for 50 years? It moved with gold, but it didn't move in the dimensionality that gold moved. One reality, a new reality, now a third reality. Silver's just broken out of the very first reality. Well, there's arguments for that, why it occurred.
Michael Oliver outlines gold and silver may still be in the early stages of historic upside moves when viewed on a logarithmic, ratio-based scale rather than simple arithmetic charts. Oliver explains that gold has already completed two major eightfold advances, from the 1976 low near $100 to $850 in 1980, and again from the 2001 low to the 2011 peak. Today, gold is only about fourfold off its 2015 low, suggesting it is merely halfway through a comparable cycle. Silver, meanwhile, historically delivered even larger percentage surges, rising nearly tenfold in past cycles. Oliver notes that silver has now broken out of a decades-long range, with momentum signaling a potential move toward dramatically higher levels, possibly far beyond prior highs, marking a new structural reality for the metal. Let's get back to the interview.
There's one chart I want to show you that shows these events happen. They're rare, but they're not exclusive to special markets, and that's the copper and lead charts. There you go. We put out this report in late October. At that point, silver, by the way, was $48 just to make it. We were trying to show our subscribers this is a history of the price chart of copper, and below we'll look at lead in a second. But see that first low rectangle? Actually, you could go further back. Instead of the 90s, you go back into the 70s and see the same range existed up and through mid-2005. So many decades of up, down, normal reality for copper. The red ellipse took place over a span of a couple quarters. You quadrupled the price of copper between there and about 2007. Very quickly. And then look at the new range that existed since 2008. Yeah, there was a sharp drop after that. But look, the average range up there is like $7,000, $8,000 per metric ton, but about 4 times the average range that existed back in the 70s, 80s, 90s, 2000. So copper broke out into a new reality, and it didn't take it 3 years to get there. Look at a couple quarters. There was no headline. Okay, scroll down, now you see lead, another exciting metal. Okay. Same range-bound situation, going all the way back to the 70s. Its breakout occurred in 2006-07, not the same time as the copper move. It wasn't a base metal explosion. Lead was firming up, but it didn't really go ape till that red ellipse, okay? You went from an average price in that range in the 70s through 2007 of about, let's call it about $600, the average price. And you went up to 3,600, and most of that occurring in about 6-7 months. Again, not in sync with copper. It's its own thing. And then it dropped, but then look what happened after that. You went into a new reality, multiple times more than the average reality. How come silver's in the old reality? We know we have a supply-demand problem with silver. 5 years in a row, consuming more than we got. And there's not much capacity to really increase production because most production does not come from silver mines. It comes as a secondary product of the base metal mining, which means you can take the ounce of silver up sharply, but it's not necessarily going to impact the guys who manage a copper mine because it's too marginal in their overall production to increase production just to get some more silver, to get the point. So it's a very unique position. Plus, we got a bull market in gold, and silver moves to monetary metal, and it's undervalued, and therefore it could go ape. It's happened before, not just copper, lead. I could have thrown darts at half a dozen other markets. Bread prices or something. In silver, one, it would be merely a catch-up to gold, making new realities every couple decades, not staying in the same reality. And then when you look at some other markets that are totally exciting, like lead and copper, they did it in a matter of a couple of quarters and at different times. So,
and it looks like, it looks like you look at copper as well. Copper is already broken out of this channel.
This is an old chart. You're already above there. You're going for another dimension. Yeah.
Yeah, it's a third dimension.
Yeah, third dimension, yeah. Why not? Of course, we all know the underlying reasons, aside from specific supply demand. Silver's got that unique thing. The ongoing decay in the real value of the money units. I don't have an M2 chart here, but if you did, it would look like this and look like these guys are just catching up to M2, the degradation of it. It's an upward curving arc. Yeah, look at that. Go back to the 70s, get that number and multiply it times what to get where you are now.
Yeah, it's about 1 trillion in the 70s.
Yeah, okay. And then,
So it's 20 times what it was in the 70s.
Yeah, okay. So That's why a loaf of bread, or no, I probably told you this on an interview before. When your dad built a house, it was $45,000. When his dad built one, it was $4,500, and now it's $445,000. What's that mean? Well, M2.
Oliver highlights how rare but powerful new reality price shifts have occurred across multiple commodity markets, offering insight into silver's current setup. Using copper and lead as examples, Oliver explains that both metals traded in narrow ranges for decades before rapidly breaking out, quadrupling or more within just a few quarters without major headlines. Copper entered a higher price dimension after 2005, while lead surged independently in 2006, 2007, rising nearly sixfold in months and then sustaining higher average prices. Oliver argues silver remains stuck in an old reality despite persistent supply deficits and its monetary role. With gold already in a bull market and currency values steadily degrading, silver may be poised to follow other commodities into a dramatically higher pricing dimension. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. Thanks for watching.